have you actually insured yourself in terms of health insurance, and have the GST exemptions compelled you to buy insurance because it's become cheaper? What has it actually done to companies that provide this kind of insurance? Welcome to KYC. I'm Hiral Dadia, and the company on KYC's radar today is Niva Bupa Health Insurance. Now, why are we talking to Niva Bupa? Firstly, it's reported numbers. The question from here on is going to be the high growth momentum and the higher ticket sizes. Is this going to be sustainable for the company from here on? And the kind of initiatives that the company has taken for H2 to meet the regulatory threshold of that 35% mark. That's the second question that we're going to talk to the management about. The measures that they have been taking to back this sustainable profitability from here on, and the impact of GST 2.0 on growth or the distributor behavior from here on, and if the volumes have gone up, has it really impacted the business from margins perspective? And what are the steps that are being planned to bring the loss ratio under control? Because if you talk about the combined ratio of the company, in the last 3 to 5 years, it's been pretty steady, but this quarter you're seeing some bit of troubles that are brewing over here. So what next is that we should be looking at? But let's quickly tell you about the company from here on. Overall, it's a standalone health insurance company and a non-life business as well. They have a JV between FettleTone and Bupa Singapore Holdings, which is a UK-based global healthcare expert. In fact, Niva Bupa is the third largest health insurer in India after New India and Star Health, and largest seller of non-life insurance on online insurance web aggregators. Now, when you talk about the core business, they have multiple aspects. They talk about individual plans, family plans, corporate plans. They also include critical illnesses, and they do give a personal accidental cover as well. And in terms of their network hospitals, it's little more than around 10,000 hospitals that they have on their network, and that's about Niva Bupa. In terms of the product mix, 69% of their product comes in from the retail health side. Around 29% is group, and others is around minuscule, 1 to 2%. So that's with regards to where Niva Bupa goes. Let's quickly run you through all the rating parameters. Now, first up, we'll be talking about the income statement, the average ticket size, return ratios. Market share becomes important over here as well, along with the return ratios. Shareholding, street credential, and valuations, along with the street coverage. Now, on this episode, you will see a couple of your parameters that have been rejected, and that's because it is an insurance company that we're talking about, and the relevant parameters have been taken into consideration. But first up, let's quickly look at the income statement from here on. Now, if you talk about the growth in the gross written premium, that is the GWP, that has been exceptionally strong, and it has significantly outpaced the industry growth rate as well. And what this trend demonstrates is the company's aggressive and successful strategy when it comes to capturing the market share in this fast-growing Indian health insurance sector, which is really underpenetrated, and hence the growth rates look pretty strong. Now, the company's focus, which is on retail health, it's almost around 65% of the product mix in FY25, is a significant driver, as this segment actually yields higher margins, and it's a stickier business than group health. So that's the reason why we're talking about this one. Now, if you talk about overall in terms of this quarter as well, now the net loss is at around 35 crores versus a profit of 13 crores. But if you talk about from an IFRS perspective, the profitability has actually more than doubled. The net premium earned has gone up around 17% at around 1,422 odd crores as well. The net loss, that is on the back of a higher underwriting. In fact, the company has actually maintained a strong claims settlement ratio of around 95.2% in the second quarter of FY26. The solvency ratio has also improved. The gross premiums written have gone up by around 3.7%. And what is interesting is that the management has actually reaffirmed its medium to long-term return on equity guidance from here on. So that is going to be something that we will ask as well as to what is it that will take them to move slightly upwards. But a thumbs up coming in on the income statement. Moving on, the second parameter is the average ticket size. Now, if you talk about the average ticket size per policy for Niva Bupa Health, that has shown a strong, consistent upward trend over the last 3 financial years. And this increase is a crucial indicator of the company's success in targeting premium customers, promoting higher sum insured policies, and benefiting from the price hikes that have been taken so far. In fact, the sustained increase also that you're seeing on the screens in the average ticket price over the last 4 years from a 22,186 to almost a 30,252 suggests several strategic and market factors that could be at play, from the likes of premiumization to probably a product mix shift. Even price hikes and medical inflation could be one of the factors, and higher agent productivity is what you need to take into consideration. Moving on, that's a thumbs up again coming in there. Let's look at the returns from here on. If you talk about the third parameter that we're talking about, return ratios, I mean, these are more of, the ratios that we need to consider over here, because the core challenge for any health insurer is managing claims and the operating expenses effectively. And that is actually summarized by the combined ratio. If you see the combined ratio, it's actually moved up from 97% to almost 101.2%. Now, the most significant operational achievement is the improvement in the core combined ratio, which excludes the accounting impact. The loss ratio at around 71.2%, that has jumped almost 1,000 basis points on a year-on-year basis. And the ratio was actually hit by a 1:9 accounting, as well as a higher group health loss ratio due to a 50% URR accounting. If you talk about the OPEX ratio of around 21.2% and the commission ratio of around 19.3%, that has resulted in that combined ratio of 101.2% that we're talking about right now as well. And if you do not consider the impact of 1:9, the claims ratio for first half of FY26 probably increased around 69.1%, while the expense ratio, including commissions, improved to around 37%, leading to a combined ratio of around 106.2 versus 103.5% that was in the first half of FY25. So that's what we're talking about, and hence you're seeing that return ratio, slightly a neutral rating is what we've given so far. Moving on, let's look at the next parameter, is the market share. Now, the retail health market share, there has been a consistent gain, which is steady, and a visible increase is what you're seeing from a 7.02% in FY22. It's actually moved up to around 9.9%. So this gain is pretty steady, visible. The company is actually successfully targeting the high-value retail customers is what comes to our radar on this one. If you talk about the SAHI market share, it's a growing contender right now, because that is consolidating its position as a major player against the dominant leaders like Star Health. And if you talk about the retail health accretion as well, that is high, but it's actually now normalizing. So this is the share of new premiums that is added. While high, it has slightly reduced as the book matures, but it still reflects a strong new business growth, which is a positive as well. And the overall health GDPI share, there we are seeing a gradual rise which is coming in there. In fact, the retail health market share, there you go, from a 7.02 to a 9.9 is what we are seeing, and hence a thumbs up in terms of the market share increase so far. Moving on, let's look at the shareholding pattern now. The shareholding pattern is absolutely interesting. Promoters, almost steady. The DIIs and the FIs are the ones who've actually reduced their stake, and that stake has actually got lapped up into the retail investors, portfolio, because your retail investors have actually gone up from 18.6% to almost a 25.4%. So they are the ones who are now very much, participating when it comes to investments in Niva Bupa, and hence, probably a downward rating, a thumbs down on this parameter, because your FIs and DIIs have reduced their stake as well. Again, in terms of street credentials, it's a thumbs down, because it's actually underperformed across parameters. If you talk about 1 month, 6 months, even a YTD basis, it's a downtick. It's actually given negative returns to investors, and hence a thumbs down on this one. And valuations, you'll be astonished to see what the valuations of a Niva Bupa are looking like. If you talk about the 12 months trailing PE, 147 times versus 53.6 and a 35.9 for a Star Health and a ICICI Lombard, whereas a Star Health is still a leader in terms of market share in a couple of categories. Niva Bupa, probably because of the high growth potential, is demanding a valuation of around 147 times, and hence we've actually given it a neutral rating, because they're up the roof. Very lastly, if you talk about the street coverage, about 7 buy calls, 2 holds, it's got an upside potential of around 13 to 14%, and hence a neutral rating coming on that front as well. So these are the 8 parameters that we've tracked so far. Let's quickly take you through everything in terms of the totality that comes in. Income statement, average ticket size, market share is a thumbs up. Your return ratios is a neutral for this one. Apart from that, if you have to look at any of the other 4 parameters, shareholding, valuation, street coverage are neutral. Your street credentials is a thumbs down. And this takes us to a total rating of 4.5 on 8 for a Niva Bupa. In fact, to take this discussion forward, let's get in Vishwanath Mahendra, Executive Director and CFO at Niva Bupa. Vishwanath, welcome to the show and always a pleasure to speak to you at NDTV Profit. You know, my first question coming to you is, overall, we've seen a good improvement when it comes to the combined ratio. This quarter, there is some bit of deterioration that has come in there. From here on, what are the steps that you're planning to bring your loss ratio under control?
Yeah, good morning, Hiral, and thanks for inviting me to the show. So let me just give you a perspective on the numbers which you have quoted. So one is IGAP numbers which are published, which are reported statutory standard. The only point I'll make is there is noise in this data because there was accounting change mid of last financial year, and because the accounting change was all those multi-year policies were mandated to be accounted for in a different basis, which is 1/n basis. And so what happened, we have on the one hand claims and overheads largely same, but earning has gone down under this method. And that's why we also report our numbers on IFRS basis. IFRS is globally standard, and since we are part of Bupa group, Bupa is on IFRS. Our accounts get consolidated, and we get our accounts audited on IFRS basis. So my request to you is to do look at those numbers also, which are consistent and growing. Our PAT has more than doubled in
yeah,
last quarter.
Vishwanath, we have considered both the profit numbers. I mean, the loss number, which is without IFRS, and the profits which have doubled basis IFRS. So both have been taken into consideration.
Yeah. So on your question on improvement here on, our combined ratio on IFRS basis has improved from 104% last financial year H1 to 103%, and largely the improvement is coming from improvement in expense ratio, which has improved by 2 basis points. In fact, loss ratio has slightly inched up by 1%. So overall combined ratio is 103%. And going forward also, we feel that expense ratio, because of operating leverage, because of economies of scale, should improve further. And that is where the improvement will come from.
Vishwanath, what will take you to the long-term target of below 100% when it comes to the combined ratio? And what are you looking at in terms of FY26 as a whole?
So what will take us is, with increase in business volume, and now we have seen GST is a very big impetus in improving the business volume, the growth. What happens with economies of scale, your expenses get spread over larger base, and that's why you get operating leverage. Your expense ratios goes down. Loss ratio, even if it stays same, expense ratio going down, that's something which will bring down our combined ratio to below 100 level.
And what any timelines that you could give us?
See, we are targeting mid to high teens ROE by FY29.
Okay.
So that's the guidance, broad guidance we give.
Okay.
We don't give by quarter or financial
Got it.
years, but
Got it.
that will be a smooth trajectory, and I'm talking about IFRS here.
And when it comes to expense of management ratio as well, the IRDA has mandated a 35% expense of management limit, and that is a key focus for standalone health insurers as well. Now, given the recent performance of the company, what is that roadmap and associated quarterly milestone looking like to ensure compliance with this limit by the end of FY26?
Yeah, Hiral, very good question. So expense of management is a big focus area for us. I can just talk about numbers. So IRDA says 35% plus some allowances for insurtech, insurance awareness expenses, etc. So that number for H1 comes to 35.8%. So 35.8% is allowed. against which our actual number is 36.3%. So we are 50 basis point higher than regulatory limit for H1. But if I just give you trajectory, last financial year H1 it was 40%. So there is a 3.7 percentage point improvement, and basis this we are very confident that we'll be able to meet the we'll be able to meet this regulatory limit of 35 plus allowances for this whole financial year.
So that looks positive. When you talk about the investment income, the premium growth has been strong. So how is the investment book being managed currently, and the expected yield trajectory for the second half of the financial year?
Yeah, so our yield for the first half is around 7.3%, and the AUM is roughly 8,500 crore. And we have largely invested in bonds and either these are sovereign bonds or high quality AAA bond, or a very small portion of AA plus, which is single digit. Sometime back, we also started with the Nifty ETF investment, AIF, those REIT, InvIT, etc. But that's still a small portion of our portfolio, around 6% or so. So we give protection more weight over return. So for the second half, we feel that yield should be at same level as H1, range bound.
Okay, so range-bound yield is what you're looking at. What about, the retail health premium growth? Because that has been strong in the second quarter. So has it come in because of new customer additions or the premium price hikes that have come in? Or is it higher sum assured or cross-selling? What has led to this growth? And secondly, when it comes to the recent GST rationalization as well, so how is the company actually leveraging this in the retail segment to actually increase your market share?
Sure. So very important point. So our growth rate in retail was 28% for H1, and majorly driven by number of lives covered. So our volume growth, which we measure as number of lives, was 22%, and ticket size was 5%. So that's the quality of growth for H1. GST is a big impetus to growth. We have seen very good traction, and October was a full month of after GST exemption. We have seen people buying health insurance because this has solved for affordability of health insurance. If you see, after COVID, awareness was already there of this product, but now affordability also solved. A lot of fan-sitters who were thinking are buying health insurance now. We have seen uptake in all the metrics, whether it's Google leads, whether it's conversion rate. All channels are showing very robust growth. If I can share with you, in October, our growth rate for retail health was 40%. So against the 28% for H1.
Okay. Let's move on to the other aspect, and continue with this, the GST impact. A lot of conversations that we had when the announcements did come in, and all of us were thinking and doing our back of the envelope calculations of this is going to be the impact on the premiums, this is going to be the impact in terms of the company. What has been the actual impact?
Yeah. So one is, as I told you, it is a very big move, and we decided that we'll pass on the complete GST benefit to customer, because once there's volume increase, a lot of things are taken care of, whether it is for distributor, it's their income in terms of commission brokerage, for us as health insurer, risk pool, and it puts this positive spiral, and insurance penetration is still low. Around 6 crore lives are covered under retail health insurance out of 140 crore population. So we feel there is a big room to grow. There is huge potential. So we decided that we'll pass on the complete benefit to customer. So and we are seeing that positive trend which I talked about. Now,
Vishwanath, so what is the impact on financials then? I know you've passed it on to the consumers. Is there any hit that the company has taken?
So, related point is that input tax credit is not allowed because
Correct.
This output is exempt. Input tax credit had two portions. One is commission, GST on commission. Second is on overhead. Overhead, we decided we'll bear that, and the increase in volume will take care of. The commission we have passed on to distributor, and we feel that even their income will also grow in terms of absolute amount, even if a percentage gets adjusted because of this GST. And for overheads also, it's a small 50 bips impact on combined. But there are other things what we are doing. For example, we talked about increase in volume. Second, GST is also exempt on some life-saving drugs, and it has been reduced for some other medicines from 12% to 5%. So that's also giving positive results. So net, we don't see this to be, any impact on bottom line.
Okay, so no impact on bottom line is what you're saying. Moving on, if you have to talk about, the claim management, how is the strategic expansion of the preferred provider network, that's the PPN, which aims for more affordable, care setups, that has actually specifically impacted the average claim size and the overall claims ratio in the PPN covered cities. Are you seeing any shift there?
Yeah, so our medical inflation, it is range bound between around 5-6% per annum. And preferred provider network is one of the initiative we have taken, which is helping wherever we have those PPN network. We have around 855, 800, 900 hospitals covered in 44 geographies. And wherever we have this PPN, we feel this is giving us better results in terms of lower average claim size.
And when it comes to group health portfolio, now, we all know that the group health is always something which is very volatile. It's often associated, when it comes to corporates moving from here to other. What is the strategy for managing the exposure when it comes to lumpy corporate group health business? And what is the target share of the group segment in the overall GWP that you're looking at by the end of FY26, and any impact it could have when it comes to margins or even profitability?
Yeah, group health has two, three segments. One, of course, is SME, which is profitable, and that's the focus area for us. In H1, we grew our SME book by 30%. Of course, in terms of size, it is still small of total business. But group health last year was around 12-13% of our total top line. Group health corporate, I'm saying, not B2B2C. Group health was corporate was 12-13%. We are comfortable with that, just that we don't want to write any account which is loss making. So that's is our strategy around group health.
Got it. All right, Vishwanath, thank you so much for having this conversation with us as well.
You.
And clearly, basis IFRS, the profits have actually doubled and your gross premiums have seen a growth as well. But completely out of time, folks. Thanks for tuning into KYC only on NDTV Profit for your profit.